If you are collecting Social Security in 2026, there are three major changes that just went into effect that could directly impact your monthly check and your taxes. AARP just released their breakdown of these updates, and there is some important information every retiree needs to understand right now. Plus, there is a hidden tool that AARP offers that can help you estimate your tax refund in minutes, and most people have no idea it even exists. Before I break all of this down for you, if you are not subscribed to this channel, hit that subscribe button right now and turn on notifications. We cover Social Security news and updates every single week, and you do not want to miss information that could put more money in your pocket. Now, let me walk you through exactly what changed and what it means for you. The first major change for 2026 is the cost of living adjustment, also known as the COLA. This year, the COLA is 2.5%. The purpose of the COLA is to help make sure your retirement income keeps pace with inflation. When prices go up for groceries, gas, utilities, and everything else, the COLA is supposed to give you a raise so your buying power does not shrink. You may have already noticed the increase in your January benefit payment. However, here is what most retirees do not realize. Most people are not actually seeing the full 2.5% increase in their checks. The reason is that the standard Medicare Part B premium, which is automatically deducted from most beneficiaries' payments, has risen by about $21 per month for 2026. So even though you technically got a raise, a chunk of that raise is being eaten up by higher Medicare costs before the money ever hits your bank account. After the Medicare Part B deduction, the typical retiree is seeing a net increase of around $35 per month. That works out to about $420 extra per year. It is not a huge windfall by any means, but it is still important inflation protection for the millions of Americans who rely heavily on Social Security for the majority of their retirement income. If Social Security is your primary source of income, every dollar matters, and the COLA helps ensure that your benefits do not fall further and further behind the rising cost of living. The system is not perfect, and many retirees feel that the COLA formula does not accurately reflect the expenses that seniors actually face, particularly health care costs, which tend to rise faster than general inflation. But for now, this is the system we have, and the 2.5% adjustment is what beneficiaries are working with in 2026. The second major change involves the retirement earnings test, and this one is especially important if you claim Social Security benefits early and you are still working. A lot of people do not fully understand how this works, so let me explain it clearly. If you start collecting Social Security before your full retirement age and you continue to earn income from work, the Social Security Administration uses something called the Retirement Earnings Test to determine whether your benefits should be temporarily reduced. The key word there is temporarily, and I will explain why that matters in a moment. Here's how the earnings test works. If you earn more than a certain amount while collecting benefits before your full retirement age, Social Security will deduct $1 in benefits for every $2 you earn over the limit. For 2026, that earnings limit has increased by $1,080 to $23,400. This means you can now earn more money from work without triggering any reduction in your Social Security benefits. For older workers who are earning part-time income or who need to supplement their Social Security with wages, this higher threshold provides more breathing room. You can work more hours or earn a higher hourly rate without worrying as much about your benefits being reduced. But here's the part that a lot of people miss, and it is really important. Even if you do earn above the threshold and your benefits are reduced, you do not lose that money forever. Once you reach your full retirement age, Social Security recalculates your benefit amount and gives you credit for the months when your benefits were withheld. In other words, you get that money back in the form of higher monthly benefits after you reach full retirement age. And once you reach your full retirement age, the retirement earnings test goes away completely. At that point, there are no limits on how much you can earn and no deductions from your benefits regardless of your income. This is something that causes a lot of confusion and unnecessary worry. People think they are being penalized for working when they are really just having benefits temporarily withheld. Understanding this can help you make better decisions about when to claim benefits and how much to work during your early retirement years. The third major change for 2026 involves the maximum taxable earnings cap, and this one primarily affects workers who are still paying into the system. Most Americans pay into Social Security through a payroll tax on their earnings. You see it on your pay stub as FICA, but there is a cap on how much of your earnings are subject to that tax. Once you hit the cap, you stop paying Social Security taxes for the rest of the year. For 2026, the taxable maximum has increased by $8,400 to $184,500. What this means is that higher income workers will be paying Social Security taxes on more of their annual earnings than they did last year. If you earn $184,500 or more, you will be paying into Social Security for a longer portion of the year before you hit the cap. This change brings more revenue into the Social Security system, which is part of ongoing efforts to strengthen the long-term sustainability of the program. There has been a lot of discussion about the future of Social Security and whether the trust fund will be able to continue paying full benefits. Increasing the taxable maximum is one way to bring more money into the system without cutting benefits or raising the retirement age. Some people have proposed eliminating the cap entirely so that all income would be subject to Social Security taxes. That would primarily affect very high earners who currently stop paying into the system partway through the year. Whether or not that happens remains to be seen, but for now the cap has been raised to $184,500, and that is what workers are dealing with in 2026. Now let me tell you about a hidden tool that AARP offers that most people do not even know exists. With tax season underway, a lot of Americans are trying to figure out how much their refund will be or whether they might owe money to the IRS. AARP has a free online tax estimator called the 1040 Income Tax Calculator that can help you estimate your total taxes as well as your potential refund or amount owed in just minutes. This tool is available on the AARP website, and anyone can use it regardless of age. You do not have to be an AARP member to access it. The calculator takes into account your income, your deductions, and your credits. It also features specific calculations for Social Security benefits and retirement income, which makes it particularly useful for retirees who have more complex tax situations than the average worker. Here's why this tool is especially valuable this year. The 2026 tax season is shaping up to be significant in terms of refund amounts due to tax code changes that were implemented under the One Big Beautiful Bill Act, which was signed into law on July 4th, 2025. There are several new provisions that could boost your refund or reduce what you owe. One of the most important changes for retirees is the enhanced senior deduction. This new deduction allows single filers to claim up to $4,000 and married couples filing jointly to claim up to $8,000. This is specifically designed to benefit older Americans and could result in meaningful tax savings for people on fixed incomes. There are also new provisions eliminating taxes on tips and overtime pay. If you worked a job where you earned tips or if you worked overtime hours, that income may now be tax-free under the new law. This is a significant change that could affect millions of workers. Another new deduction is the auto loan interest deduction. Previously, you could only deduct interest on mortgages, but now you may be able to deduct interest paid on auto loans as well. For people who have car payments, this could add up to real savings. The standard deduction has also been increased, which means more of your income is shielded from taxes before you even get to itemizing. For people who take the standard deduction rather than itemizing, this automatically reduces your taxable income. To claim many of these new deductions, taxpayers need to fill out the IRS Schedule 1A form. Make sure you are aware of all the deductions and credits you qualify for, because leaving money on the table is one of the biggest mistakes taxpayers make. As of late last month, the average federal tax refund is about $3,804 according to IRS data. That represents a significant 10.2% increase from the $3,450 average at the same time last year. So refunds are up substantially, and part of that is due to these new tax provisions that are now in effect. If you want to get an estimate of what your refund might look like, head over to the AARP website and use their free 1040 income tax calculator. It only takes a few minutes and it can give you a good idea of where you stand before you file. You can also earn AARP rewards points for using the tool, which can be redeemed for sweepstakes entries, local deals, gift cards, and other perks. So to summarize everything, here are the 3 key Social Security changes for 2026, according to AARP. First, if you are collecting Social Security, you received a 2.5% cost of living adjustment, though most retirees will see a net increase of about $35 per month after the Medicare Part B premium increase is deducted. Second, if you are collecting Social Security while still working before your full retirement age, you can now earn up to $23,400 before any benefits are temporarily withheld, which is $1,080 more than last year. Third, higher income workers will be paying Social Security taxes on earnings up to $184,500, which is $8,400 more than last year, bringing additional revenue into the system. These adjustments help Social Security keep pace with the economy while working toward long-term sustainability for future retirees. None of these changes are dramatic on their own, but they all add up and they all affect how much money ends up in your pocket. Staying informed about these updates is one of the best things you can do to make sure you are getting everything you are entitled to and not leaving any money on the table. If this information was helpful to you, make sure you are subscribed to this channel so you never miss important Social Security updates. Share this video with friends and family members who are collecting benefits or approaching retirement, because a lot of people have no idea these changes even happened. Drop a comment below and let me know if you noticed the COLA increase in your January check, or if Medicare ate up most of your raise like it did for so many retirees. Thanks for watching, and I will see you in the next update.